Hello and welcome to another episode of the Stock Market Today video. It's Justin Nielsen here, and we have your Friday wrap up. And joining me, as he usually does, is Mike Webster, our senior market strategist. Are we having fun yet, Mike?
Dude, I am having so much fun because the bell rang and it's
Yes.
Friday, man. Let's put this week to bed.
I'm I'm right there with you, buddy. Quite a volatile week. We're coming at you live on November 21st, 2025, and we have just seen topsy-turviness. I mean, yesterday was so unusual, being up more than 2% and then finishing down 2%. And I mean, that's something that only has happened, 12 times total in the history of the Nasdaq. But today, what do we see? Just a charge forward. The Nasdaq Composite. I mean that finished up. Well, gosh, it came off a little bit at the end there, but uh, the Nasdaq looked like it was up what 0.9% at the close. The S&P 500, that was up 1%. The Dow Jones Industrial Average up 1.1%, and the Russell 2000 taking the taking the gains leadership with a gain of 2.8%, but still an inside day. So it's one of those things that's just super crazy. I'm going to go ahead and share my charts here, and we can go through it, Mike. Um,
Sure.
and just to let people know, also, we're going to do things a little bit different today. We're going to cover some of Mike's charts, the Webby RSI and the moving average lines, the Keep It Simple, the Bob Marley. We're going to cover a lot of that in the front part here because we're going to spend some time on the market, of course, today. It seems like it's really important. But let's go ahead and start with the Russell again. Huge gain, 2.8% is where I see it finishing today, but still an inside day. A lot of times when we look historically, and again, just looking at those, I mentioned yesterday and how volatile that was. Uh, these prior 11 days all happened in like crisis situations, like the dot-com bubble. We had six of those instances between 2000 and 2001. We had three of those instances happen in 2008. We had one that happened during COVID in 2020, and then another that happened during the tariff tantrums. A lot of times when you get kind of those bad days, you have some of your best up days. In fact, if you look at the top 10 percentage gains of the NASDAQ composite historically, those top 10 percentage gains almost all happened during those same time periods: 2000, 2001, 2008, and COVID, and more recently, the tariff tantrums in April. So what should we make of this strong day today surrounded by all this volatility?
Not much. It's normal and natural. After yesterday's action, um, having a big day like today, like on IWM or Russell, for example, is normal. You do one of two things typically. You either have another leg down, which certainly was in the cards. That was a possibility, or you have a lot of going back. So think about what would have happened yesterday. A lot of people would have started hedging, would have, uh, gone short. They're like maybe reversing some of that today because they were thinking, okay, you're going to have a big waterfall type of sell off today, which could have happened. We had some positive news before the open that helped turn things around in the Fed funds futures market. So that changed a lot of what was going on there as far as it, and whether we're going to have an interest rate, whether the market thinks we're going to have an interest rate cut early December or not. And there was lots of movement there this week. And so you had,
Worth mentioning that the 10-year Treasury yield also came down a
yeah,
bit.
yeah. And you could see it in, like in the housing area. Why don't you pull up one of the housing stocks or one of the housing ETFs? Those had big moves today, and those tend to, but they're just out of position. Like ITB, like that's a big move, massive move. And the thought process there is lower interest rates help and all of that, but it's in a downtrend. So again, you can't read into a big up day in a downtrend or a big down day in an uptrend. I mean, you just have these counter trend move. So that trend is still down. It's something that I really liked earlier in the year, then it broke down, and we're just waiting. Maybe this is the bottom of the cup, and or whatever type of base structure it's going to form, and we round out. But our style of trading really isn't buying it down in this position, but you're still paying attention to where is the money flowing. So go back to the Russell for a second, because the Russell tends to be interest rate sensitive, and also that's why I think you got that big move there, as well as some money flowing out of the big caps. And where do they go? They can go, you if you're a huge fund and you sell just a little bit of your Google, your Apple, your Microsoft, Meta, what have you, that goes a long way in the small cap space. So sometimes it's the market mechanics, but I wouldn't read anything into an inside day. You by inside day, if that's not a term you're familiar with, it's exactly what it sounds like. Your high was within the high of yesterday, and your low is within the low of yesterday. So it's just marking time, and that's what you want after a bad day. I would have actually preferred for us to just take another leg down and kind of clean house. But when you go mark sideways, that could be, just base building in here. But let's look at the SPY, because that's what, most of the market participants look at, and myself included. Um, and that was a relatively weak rebound. It was 99% or 0.99%, so 1%. But still, you just look at that compared to yesterday, and it's really kind of a nothing. It's weak, and your high is underneath the 21 day, your high is underneath the 50 day, your 21 day is now coming through the 50 day. Did that end up being below it at the close, or just at it on
Bel-
SPY?
Below what?
Did the 21 day end up crossing the 50 day? Visually, it looks like it did, but if you track price it to see if it
Yeah, let's see.
actually did.
66935 for the 21 and 66915.
Okay,
So the
so still
21
a
is
little.
just slightly above.
Okay, and then let's do the same thing on the Nasdaq. And the reason why this is important is there's this thing called the power trend that Justin and I came up with along with Charles Harris. And it ends when your 21 day crosses below your 50 day. There are other ways, but that's the primary way. Is that it's hard for me to see those numbers. It looks like it's still above it,
Yeah.
correct?
And and
Okay.
and my calculation I gave on IBD Live this morning was basically if we closed up 0.5% today on the Nasdaq Composite, then the 21 day would remain above its 50 day. I just kind of typed some numbers in, and that's what it looked like. But it certainly wouldn't take much. And in fact, it would take a lot in order for it to not close below the 21 to close below the 50 day on Monday.
Yeah, and it's really semantics. When you're looking at rules, back in the day, I used to be very hard and fast, and it's like, oh, what does the Excel spreadsheet say? But now I've gotten more to like, what is the concept of the rule? Or the
Mm.
concept of the rule was you're in this big trend up, and you need something to tell you that that has changed. And what we decided, we also wanted to keep it simple because we were trying to teach this to folks and follow it. And using the 21 day crossing below the 50 day was the most logical, easy thing to do, especially since those were the instruments that we used to start a power trend. A power trend essentially is two things. It's four things, but it's really just two things. The low being above the 21 day for 10 consecutive days, and the 21 day being above the 50 day for 5 consecutive days. You also have to close up, and then you want the 50 day in an uptrend. But it's really those the two other things are the harder things. That starts the move, and we got that early on pretty much every index and most ETFs, in that May, June time frame. And so that was a very powerful rally. And eventually it needs to go through a corrective phase. That doesn't mean you're going into a bear market, but you don't know. Remember, Bill O'Neill, the founder of IBD, one of my favorite things that he would tell us was we are not in the prediction business. We are in the interpretation business. So we're interpreting what's going on. And really, for the last 2 months, it's been very
Mhm.
sloppy and choppy, especially for a style of trading that I like to do, swing trading. And my subset of swing trading of buying in strength, unless it's an upside reversal and having a tight stop. That's been just chopping people up, myself included, for the last couple months, and or last 6 weeks or so, but maybe 2 months. And so that was one warning sign, is what type of feedback are you getting from your trading. Now people who are position trading and had stocks that were like, really in a nice uptrend, and they were letting them wiggle and wobble, that was different. There was a lot of money to be made there. Let's pull up like a sand disk.
Mhm.
um, this was one that, if you had position traded it and you bought it around 50, 48, 49 or so, and then you had that big move, you were still making a ton of money on the way up. Now it's going through its corrective phase, and let's talk over to the weekly for a second, because there's lots of them that look
Down
like this.
30% from its high.
Yeah, so you've got this type of move, and stocks are always entitled to pull back to their 10-week line, and that's still a way. How far away from our 10-week line?
So we're still 20% above that line.
Okay, and that could be in the cards, and it's still not broken. But from a percent off high, it would feel really, really bad. But
Yeah.
so there's two kind of groups: the swing traders who have been chopped up for a while, and now let's go back to the daily. The position traders that would have been giving back a lot, pretty probably this week. Like let's look at Micron, which was another one like this. It had this monster move, and then it had its corrective phase this week, and now it's getting support right at its 10-week line, and has this 50-day, and it might bounce from there, or this might be the left side of a base. You know, it could be over, but typically when the stocks make moves like that are that powerful, and then they start correcting, they just have to do some time. So you want to think through and study, other strong pullbacks to the 50-day if you're trading something like this, to know how, like, how would you want to get into it, or how would you want know to keep your position if you're in something like this. um I would use today's low as your stop and just go, you know what, is if I sat through this much pain, as long as it holds above today's low, I'll just let it doodle around. But um, so, anyways, that's a long way of saying a lot of people got hurt. Now, let's go back to the cues, for example.
And the one thing I will add is, the just be careful that when you set a stop, you don't keep on resetting a stop. So for instance, if you had said, "Oh, I'm going to take, I'm going to cut if it goes below the 21-day moving average line," and then you're like, "Oh, wow, it really cut that all the way down to the 50." Well, I'll just see what happens at the 50, and then it goes down, and then you're like, "Oh, well, now I'll see what happens at the low." You can easily find yourself, uh, taking a much larger drawdown than you expected. So be very careful. When you set a stop, to honor it and not just keep on making excuses for it. That's a rookie move that can get you in a lot of trouble.
And I'm glad you brought that up, because another way folks can handle things like that, because it is very difficult psychologically. Let's say the 21-day is your stop, and you use it and it hits that, and it just comes down to that. You get stopped out at the low. I've had that happen a million times. Then it turns back and goes up. You're like, wow, I shouldn't use stops next time. Like that cut me up. So if, let's say, you have 100 shares, well, put 10 share a stop for 10 shares there,
Yeah.
put a stop for, the next level, another 10 shares. And you could also offensively sell things into strength, or there was a downside reversal above 250, you could have sold some there. So most people should do it gradually in and
Mhm.
gradually out, not just because of how the math works, but psychologically. Like, there's nothing worse than selling at the low and then having something turn back around. And if you're not willing to buy it back, it can really do a lot of psychological damage to you. You want to, keep your confidence trading, because that'll keep you fluid. Doesn't mean you're always going to make the right decisions. But, anyways, let's go back to the cues for a second.
I also
So
feel
we,
like that incremental buying and selling um, does put you more on a feedback loop.
yep.
It's like the market gives you feedback, you react. The market gives you more feedback, you react, and it just keeps you in phase a little bit better a lot of times. But back to the
Well,
cues.
yeah, well said. So the other thing, the market wants to frustrate the most amount of people, right? So you had the swing traders getting chopped up. You had the people who, the position traders, finally getting hit this past week, or some of them a little bit earlier than that. Pull up Oklo for a second. So I'm I'm trying to, like, bring in different themes. So the superheat high octane names, which I think Oklo is the poster child for, That's 54% off of its high. And that topped, you know, a month or so ago. What is it like what was the date on that?
Yeah,
Yeah.
so
So,
October 15th. And it was
Oc-
wild because on that day, October 10th, when it was such a wild day in the market, it almost was like a rotation even more to the heat. Some of
mhm.
these heat stocks, Oklo being one of them. Yeah, so.
And what about the IREN, the IREN, which was another one of those types?
hmm
Yeah. So the
So
same.
this, yeah, on the 15th, but then it came back and made highs on November 5th too.
Yeah. And then you had BE, which was holding up better than most, and then that finally got hit. So the market has a way of kind of getting at everyone. Now let's go to the cues. I'm sorry, my brain is, it's been a long week, so my brain is a little all over the place because the two of us are working on so many projects. It's like trading is just a little small part of what we're doing. So with that bad day on 1010, if you could just point to that, the most logical thing was for us to mark time or to really go lower, but instead it went higher. So I'm assuming a lot of people got short in there, which was a logical thing to do, just not my style of shorting, but to short in there, and then they got squeezed. So the market has a way of just kind of humbling all of us, maybe not on the same day. That's constructive. That's the reason why I bring this up. Let's bring up the other one, the elephant in the room, IBIT, because even though I don't, whenever I trade crypto, I just trade IBIT or ETHA, and I just do it in a small way. But there's so many people who are really invested in this area, both psychologically and financially. Let's go to the weekly on this one. That when, yeah, off 33% and in just a blink of an eye, really. And it didn't really give any major warnings. There's always this, the Tuesday morning quarterbacking hindsight stuff that I'm not a fan of, that you can find things in there. And there was some stuff, but really, crypto is all over the place all the time. And this just came down, and every time it looked like it should rally, it didn't. But I think that a lot of what we're seeing in the stock market is because of the crypto space getting hit the way it is. We did have all like kind of the junky crypto getting hit a while back, but then Bitcoin and Ethereum worked themselves out, and now we kind of have this going on. So you have a lot of people getting hurt in the market, and that's why you get moves like today. Like, let's go back to the Qs and go on the daily, that you have the mentality of, oh, I want to make it back, I just got my head handed to me, or you had death by a thousand cuts type of thing. And so you're going to get these violent moves like we had yesterday and today. So what do you do with that? You wait. You turn into a turtle and you kind of go in your shell and you get smaller. It doesn't mean you stop trading or you go to cash. You can do that, but you get smaller and you take less risk, and you do smaller positions when you go in until, like you were saying, the feedback loop, you start getting positive feedback. You start putting on some trades, they're working, then do more of that. And you don't have to stay small forever. It's a concept I got from Marty Schwartz, who was one of the market wizards. If you haven't read the Market Wizard series, read all of those. They're great. But he was called the Pit Bull, and he wrote a book called Pitbull. And he talked about when you're going through tough times in the market, whether it's just the market's difficult or you're just having a hard time, just get really small, and it still allows you to trade. And then once the trades start working, then you start making them bigger. So the key thing here is everyone's getting chopped up. If you're the one person who hasn't got chopped up yet, maybe sell everything because it's probably around the corner. Um, but I'm happy for you if you. There are some stocks that have just been killing it, and there's going to be some people. Everything is a bell-shaped distribution. There's going to be some people that got totally killed, and some other people that are on the other end who are just killing it. Happy for them, but just be careful because we're getting lots of warning signs here with the market. And I think the basic thing is you need time. Time heals a lot of things. And so we need the volatility to start coming down. We don't want these big up days. You don't want an IWM up 3%. You want an IWM up 0.3%. That tells you you're at equilibrium. And we've got next week with it being
Well,
a
even
holiday.
worse, it's
Yeah,
it'll be up 3%, then down,
yep.
2%, up, 2.5%, down 3%. It's that kind of volatility day to day that really is tough. I mean, I think we could all handle, a number of 3% days up in a row, back to back for weeks. That would be great, but it's the back
Sign
and
me up,
forth. Yeah,
Justin.
right, exactly.
Could you
It's
get
this
me on
back and
the email
forth.
list?
Mike, do you want to start showing some of your
Yeah,
charts, and we can kind
yeah,
of go through a little bit more
yeah,
details?
we are going to do our like if you came in late, we are going to do what Justin and I normally do at the beginning of these, but we're going to just do that at the end because the market is so important right now. We're going to focus on the market charts, then we'll go through the sectors and we'll do the individual stocks at the end. So I'm going to share my screen real quick. Let's see, share screen. Most stressful time of my week, Justin. And is it working?
Yeah.
Okay. So this is our time where we take a step back. It's the Bob Weir take a step back and look at the weekly candles and see what it's telling you. And honestly, on a weekly basis, and each one of these we look at it in isolation, and then we kind of put all the pieces together to paint this mosaic. So we're looking at this and going, is there anything really abnormal on a weekly basis? No, you had a stalling week up here, then you had a poor candle here, another poor candle. So what would you expect? Another poor candle. Yes. And so this was a weak candle, but not terrible. Why is it not terrible? Because I'll blow this up a little bit. If you look at the bottom wick down here, it's longer, slightly longer than the top wick. That I look at as positive. The negative aspect of it is the fact that it's a pink candle. That means that it opened up here and closed here, which is a weak position. But we didn't have any wild action on the weekly, meaning we had a lower high and a lower low. So that's in a trend, but it doesn't look terrible. There are other times where it would look terrible, like over here. This back on March 28th, tried to break above the prior week's high, and then closed down, closed at its low underneath the prior week. So it was an outside week, and that was telling you not necessarily that it was going to be this ugly this week, but that was a bad candle. Whereas this one here was it had this super long wick, and that was positive, but you didn't have a lot of follow through the next week. So that's how you look at these. Let's take a look at the NASDAQ and see if we see anything different. Yeah, basically the same picture. And most of the time, that's going to be the case. When there's a divergence, you pay a little bit more attention to it. Let's go to our
Maybe, and maybe my eyes are tricking me, but it seems a little bit more evenly spaced on the wicks on the top and the
yes,
bottom for this week.
yes, it does. So
Not
look
as
at
favorable as SPY.
yeah. So we'll go over here, SPY, and you see how this one is a tiny wick, and this is a little bit longer, and then we'll look at the composite. Now let's look at IWM just for fun. So really nice candle there, right?
Hmm.
Super long wick, tiny little body, and it's up in the upper half above last week's low. So that's a really nice weekly bar there. Let's toggle over to the regressions that we used to use. Oh, I'll go to start with SPY. And this was the one, the May 12th was our first anchor point, and our second anchor point 50 days later was July 22nd. And that fell out of that trading range back here on October 10th and could never get back through there. Same thing on the composite on the NASDAQ, broke the same day, tried to get up in there and failed. So we started using some alternative regression lines with different dates, and that was I was using August 1st as well as the October 10th. It happened to be 50 days out from there. And this is what was really throwing us a lot because it was acting nicely. And how you use these is as you come down near the solid green line, your expectation is for it to bounce back up to a mean, it's called a mean reversion trade, to move back up to your line of best fit or the white line or what I like to call home base. That's where it wants to live as long as it's in that trend. And over here and mid October, it bounced up, did exactly what you would think, got up near your half standard deviation above it, or your red dash line, which is normally where you kind of slow down a little bit and then just hover around your home baseline. So it was acting really normal and natural here. Then it fell down to your green line, your -1 standard deviation, and that happens all the time. Your expectation was for a move back up to the white line. Started there, then it failed, then it really got ugly, then it got, look, it had all these false starts where it looked like it was going to go back. On this day, it really looked like it, you could gun it and it would get back up to the white line, but it failed there. This was your key day, the November 13th, where you broke back through there. And at that point, you're saying, okay, if it lives underneath this green line for another couple days, we've got to throw this trend out, saying this trend is done. And really, at this point, whether you want to call it the 18th or the 19th, that trend is done. There is no way to put Humpty Dumpty back together. You have to wait for a new trend. Doesn't mean that we're going to go down. It just means you can't use that regression line. If we were got some great news over the weekend, I don't know what that would be, but maybe the Ukraine war ends or something else really significant happens and you come up here, you can't use that line because it's broken down from there. Same thing with the composite. But what it does tell you is another reason to be very, very concerned, because you don't know what the trend is, other than right now you're in a short-term downtrend from the peak there, but not long enough to put regression lines on. The next thing we were going to look at is the 50% retracement, and we'll start with SPY. And with this one, I'm still using the October 10th high and low because I think it really, there's all sorts of ways you can do this. You could use the low from October 10th and our high over here. That's totally valid. There's lots of ways you can slice it. You could take the high and the low from yesterday, slice it that way. But I think the 1010 is good for what we're discussing today, is that was kind of the game changer of the market on that day. And if you're above this midpoint, the 50% retracement, 663.40, then you're living in what I call the northern hemisphere, and that's a positive place to be. If you're in the southern hemisphere, then that's in a weaker position, and that's where we are right now. So we want to at least start living up here again, which we were for a bit. And then again, you can slice that a lot of different ways. Let's look at that on
Very
the
interesting that yesterday, by the way, actually was higher than the October 10th high and lower than the
Yep.
October 10th low. For as wild as that spread was, the fact that yesterday was even larger. The position was very different because, again, of the gain that it had, you know, uh, considering the previous day, as opposed to just falling apart, at the get go. But yeah, very, very interesting that it was that wide of a spread.
Right? I mean,
Mhm.
crazy. I don't, the two of us would have to kind of go back and try to find other times where that happened. And it's, man, I think it's going to be very hard for us to find such a wild day and in a short period of time have such an outsized day in the same space and
Right.
go higher and lower. It's just like, this is like, have I seen this before? No. I mean, I cannot picture it in my head. And
Mhm.
I look at a lot of charts. So this is rare. I'm not saying it's not out there. It would be hard to, it would
Again,
be
what
hard to find.
seems like more likely is those big spreads one after another, back and forth. Again, like what we saw kind of in April, or even, yeah, in those times of higher volatility,
Yeah. Like
where,
down
yeah,
in
a
this
lot of
area.
just big spreads.
Yeah, that's normal and natural in
Mhm.
that position, because what the market is trying to figure out where equilibrium is, and it's all over the place. But what was unique about this was you had that day and then it was like, oh, the market just forgot
Separation.
about that day. And then it's just the when you see things that are unusually weak, you want to pay attention and take action on that. Unusually strong, you want to do the same thing, but it's different type of action. So this is a warning sign. Like I always say, that the animal kingdom is filled with warning signs. You see a snake that's got all sorts of weird colors on it, probably, or it's rattling, it's telling you stay away.
Hmm.
And this is another one of those signs. So let's move over to our next one. And this is our lines. And these are all the same lines that we've been looking at, with the exception of I did put a positive green line up here on the date on the 11/12, just because once we get through that level, then that would be a positive thing. Also, getting above the level of yesterday's high, that's what I'm looking for. I'm not going to take anything too seriously until we can get above that on a closing basis. All this is just kind of noise. Um, but these are still, we broke through that level here, kind of bounce above it, and then you see the kind of stair stepping down below is just, key areas. And there's more lines on here. Here's the Nasdaq, same basic lines that we have on there. And this is helpful to keep the same lines on, and try to try to not change them all the time, because that way you're like, oh, okay, 4 weeks ago I was thinking this was an important level, and oh wow, now we're back down to that. And it just does tell you something. And you could draw another 20 lines on here if you wanted to. um, but we won't. So now the next one is my chart that is relatively new for this, and it's a bunch of moving averages, from short-term moving averages to longer-term moving averages. I like going with Fibonacci numbers. You can go with any number that makes sense to you. So this is a 3 day, a 5 day, an 8 day, a 13 day, a 21 day, a 34 day, and so on, of the Fibonacci numbers. And all I'm trying to do is say, are they stacked in the right way or not? And it's a warning sign, and it can be subtle at first. Up here, just slowly coming in, and that's fine. They don't always stay above, but one by one, your shorter term moving averages are starting to go through their longer term moving averages. And that's what happens during a base. If you were to study this on any stock forming a base, this is what happens. And it's just another sign that it's that time element, that you have to wait for the timing of it. And it takes time for moving averages to get stacked back the right way. And just envision that here, if we were to move up the right side, you're looking at really weeks until the 3 day is above the 5 day, and the 5 day is above the 8 day, and the 8 day is above the 13, and so on. And that's when you don't have to wait for that, but that's when you're in a position to be able to push it again. And we'll do the same thing on.
You know what? I wanted to address a quick question,
Sure.
or a statement that came out from the YouTube comment someone was talking about, and I think this was in reference to when we were having our power trend discussion.
Uh-huh.
They were asking if that, if we were talking about a death cross. Not really. So the 21-day below the 50-day moving average line is much shorter term than what's typically used as a death cross, being the 50-day, being below the 200-day moving average line. And the reason why we like the shorter term is, a lot of times by the time the death cross happens, that's when a lot of times the market turns. And same thing with the golden cross, right? The golden cross, yeah, it can be great for getting you in on a trend, but it's just really late a lot of times, and we'd like to try and get in a little bit earlier on those positions. So
Yeah, a good question. All that glitters is not gold. And I will just say, the three of us with Chuck studied the Golden Cross and the Death Cross, as well as a ton of other things back when we did the market school rules in the 2011 time frame. And it was just too late. So we dropped it out of there. But I will say, I use them a lot as where you are in the market. So not
mhm,
as an indicator, but just kind of like these lines as, okay, what type of market are you in? Are you in a
yeah,
market where the market that you want to trade in is the 21 day above the 50 and the 50 above the 200 day. That is that's the sweet spot, and you're low above the 21 day. So low above the 21 day, 21 day above the 50, 50 above the 200. That's simple. If you only traded during those times, I'm talking to myself, you would be
yeah.
much better off.
Yeah.
My
And look, we're
please.
trend followers. We're trend
Yes.
followers, and what everything you just described means you're in a trend. right?
Yes.
And so it's much easier. And I would also say the downside is true too. When you get everything kind of stacked the other way, it's real easy to stay out. It's
Yeah.
like as you said, this is your Black Widow with a big red hourglass saying, "Hey, don't mess with me." And that's easy. It's when it's kind of all this back and forth that's where it gets a little bit tougher. The choppiness is always tougher for trend followers.
Exactly. Well said. All right. So same thing on the Nasdaq. Let's look at the IWM since we looked at that earlier. And wow, same thing there. And let's look at RSP. That's your average stock. This is the S&P 500 equally weighted, and that's been chop and slop for a while. You're really so the next one we've got is the my favorite and Allie's favorite. And yes, Allie will be back next year. We are always wishing her well with her extended family now. But the with this one, it's just the 21 day on there, nothing else. And kind of like, I really like this simple view. And what I like to do is just focus, is your high, where's your high and where's your low in relationship to this line? And it's in the wrong place. Your high is stuck underneath, or is not stuck underneath because it was above it yesterday. Moved above it just to, suck you in, or to increase your positions, just to turn back around and close terribly. And so today, when you look at that bar, it's like, or that candle, not impressive. And we didn't even get close to that 21 day. Let's look at the composite. Same thing there. Let's go ahead and look at that IWM. Yeah, you're still stuck underneath there. So I'm going to stop sharing with those, and we're going to go over to the other charts. Let me get there. Um, okay, and once I'm done with these charts, I can stop stressing out, Justin.
All right, then let's just
Um,
relax. Uh,
yes. Okay. So can you see this?
yep.
Okay, so this is the spies on a daily chart, and it is my Webby RSI down at the bottom, and all that is that last chart, but visualize. So I wanted to let me blow this up. This is very important. So down here, this is just your low versus your 21 day, the teal ones, in terms of ATR. So on this day here, it's telling you that your low is 2.28, or give or take. ATR is above it. That's in a good place and in a powerful place. When it turns this burnt orange color, it means your high is underneath that. And that's what you don't want to see. And you don't want to see a wall of burnt orange, like we had over here during that time frame. So what do we need to get this teal again? We need that low to get back above the 21 day. So I'll put this back down to normal so you can see when you see a wall of orange on there, it's telling you you are in a very dangerous position, and you can see this increased volatility down there. But it can quickly turn. So how I don't use the words oversold, overbought, because Bill O'Neill would have shot us if either of us ever said those words. But it gives you an idea of, are you at an extreme or not? And so here, this kind of tells you that this was almost 4 ATRs that your high was underneath your 21 day. So if we get back down to that level, it'll tell you, okay, relative to recent history, that's at an extreme level. So the fact that we're just barely, we're not even at 1 ATR with our high underneath the 21 day is a warning sign to me, saying, okay, we're starting to slowly build one brick at a time, another brick in this wall, of orange we don't want to see. And what ends up happening is we want it to just get some blue back shortly. But if we get more burnt orange on there, it's just more of a reason to say, hey, you know what? We could probably have a shakeout, that kind of a capitulation type of low. And what I've noticed through my studies is when you have a relatively short in duration or shallow intermediate correction, you get those capitulation lows. But when the three of us were studying things from market school, I just observed that when you get those really bad bear markets, like let's say, a 1929 or a 2000 or a 73, 74 or an '07 or any of the really bad ones, they don't have the capitulation bottoms. They just kind of stop going down and start turning around, and then you get your follow through day. So since right now we're still in a very early part of what looks like a intermediate correction, I'm expecting, some sort of capitulation type of move, which what does that mean? You would see a big one of these spikes in there, and then that would tell you that you're probably closer to the end than the beginning. But if we go back in time, sometimes those spikes can, you know, um, you know, get pretty big over there. But and it's something we'll talk about every Friday. So tune in.
Mhm.
Let me go
I would also
to
say that the gaps that you see here, that is kind of again a little bit indicative of choppiness and when you're not trending, right? When you get that wall of blue, that's a lot of bricks to use your analogy, um, for an uptrend. When you get that wall of burnt orange, it's a lot of bricks for your downtrend. But when you get kind of the gaps, there's just a bunch of holes in your wall, right? So it's
yeah.
not a sound structure, it's not a sound trend. It's just a little bit more choppiness when you get those holes in your histogram.
Exactly. And that's why I wanted to visualize it because that's what
Hmm.
we see. And when you're going back and forth through that 21 day, that means your high isn't below it and your low isn't above it. So you don't have a histogram.
Hmm.
And then it's just more of a, and you can see that started happening, yeah, on that October 10th is really when everything kind of changed and you didn't have that steady long wall like you had
Yeah.
over here. And just think about it. That's where you make your money.
Right.
If you trade at all like we do, you're going to make your money when you get a wall of blue. When you don't, another reason. That's why we wanted to do these charts first. It's just a warning sign. I know everyone probably got hit this week. I got hit hard that you want to not go be in that mindset of, oh, I need to make it back. You want to put the right trades on and then you'll start making it back. If you try to do this catch up thing, it is just a recipe for really chopping yourself up. And that's what I just learned that the hard way over the decades.
Right.
So let's go to our next one, and this is our Bob. We're or Bob
Bob
Marley.
Marley.
Uh, uh,
Get your
Off high.
bobs right.
Yes, yes, it is Friday. So what this is just measuring your how far off you are off your high, and we use the low for this, and we do it in terms of ATRs. So the green zone is within 4 ATRs of your high. The yellow, which we are now, is 4 to 8, and then the red zone, that is a world of pain, and that is 8 or more. So now we've dipped into the yellow. So I use this two ways, not just what color are you in, but what is it doing versus its relative past? Is it acting in character or not? So at this point on August 1st, it came down to about 3.5 ATRs off its highs. So that the way I interpret this is that's about where you would expect it to bottom out in and around that, not to the penny or anything, but that would be normal and natural. So this on must have been October 10th. It got a little bit worse than that, but not too much worse. It was telling you it was still within character. Then this on the 7th was a little weird because you got a little bit worse, but it wasn't so materially worse that it was really out of character. It was kind of that gray area. But then we got back up here and we couldn't make it to fresh highs, but now we're taking another leg lower. So this is kind of the worst of all worlds instead of the best of all worlds. It's choppy and down. So it's making bigger lower lows, but doing it in a very choppy fashion. So it's really on the risky side of things. And let's go to the Nasdaq, and that one's even worse. You can see it kind of bottomed out around here each time, and then it went lower, and then it's just inching lower and lower. And you can see what it ended up happening here in March and April. It just kept on getting worse and worse and worse and worse. So that's what we want to guard against, and that's why we're being on the cautious side of things. So hey, stop and sharing, man. Now it's all you. Now you've got to do the hard work.
Right. Okay. Well, let's go ahead and turn our attention over to the sectors. And actually, you know what? Before we do that, I just want to address real quickly um, a little bit about the where is my okay? Here we go. Let's let's take a look at the RSP and QQEW because we have been talking about breadth and this was a little bit stronger, actually significantly stronger. I mean, SPY was up 1% and RSP almost double. The advancers over decliners, 4-1 in favor of the advancers on the NYSE. And for the NASDAQ, it was maybe a little bit more like, 5-2. So here again, QQEW up, 1.6% versus the Qs that were up, 0.75%. So is that giving you any information there?
Oh yeah, it absolutely is. Let's go back to the RSP for example. And that's a very good question, observation of folks. This was, I mean, a 2% move for the RSP is huge. Like that's a
Hmm.
really, really big move. So that's saying that the average stock out of 500 was up 2% today. That tells you a lot in isolation. Then you go and you look at the chart and go, ah, looks pretty much, if you have to squint, it's still an inside day. I don't
Yeah,
care what the numbers say,
right.
uh, even though I have bad eyesight. So it's kind of like that IWM. It was saying, it gives you a little glimmer of hope that
Hmm.
it had this big move. I'd rather it be up 1.97 than, well, actually, I would have rather it been down 1.97 to kind of get rid of, kind of get through this corrective phase faster. I honestly
Sounds like someone
think,
who has a lot of cash.
yeah, yeah. Um,
you,
the
you you only say that when you're in cash. Yeah, you know what? I want more destruction. Get everyone out.
Well, so uh, look, the reality is, let's go back to SPY for example for a second. The uh, the October 10th day, that was the beginning of what should have been a corrective phase. And I think a lot of what we've been dealing with since then is we got positive news over that weekend. And that was really what changed everything. You had the government shutdown, which caused a lot of the reports that algos and discretionary people work off of. So now all of a sudden you had this, and forget the politics of the government shutdown. I'm not talking about that at all. I'm talking about how it impacts the market. That the market relies on all of these reports, and then all of a sudden you start not getting them. Over the over a period of time, that throws people off because they don't know what to put in their spreadsheets. So their valuations of, because everyone doesn't look at charts the way we look at them. Some people don't even look at charts. They just look at their spreadsheets, or they just let their computers do the work for them. So you get this one thing that's kind of out of whack. But also on that October 10th, that should have been the beginning of at least another day and a half of some severe pain. That would have been normal and natural. But then you got this news over the weekend, and then you get that gap up on Monday. That was really kind of odd that it was such a tight day after that. And that's where I think things started becoming not normal or natural. And then when we went to new highs, it was like, wow, that shouldn't have happened. But you had to go with it because I was
Hmm.
saying at that time, and I would say it again if we were in that same situation, it felt like it could have been the October timeframe of 1999. We don't have to go there now, but that started this big trend up. And if you were waiting for the pullback or saying, oh, I just want to give it a little bit more time or some more evidence, well, then what do? Then you're going to have to really buy it extended. So you had to buy in there, but then, you got chopped up. So I think it really all started from about October 10th. And it was similar to, let's pull up the NASDAQ for a second.
The Qs or the Nasdaq
No,
Composite?
the NASDAQ, because I don't want to have that box over there. Um, if you look at the December of last year, that bad Fed day, I think it was like that day,
The
that
18th or
that
something.
that
Yeah.
was what kind of started that corrective phase. You had this bad day, and then during that you ended up having deep seek and all that. But that was normal and healthy. That's what you want to see. You don't want things going straight up, and you don't want them going straight down either. You like them to go back and forth. Now you get chopped up that way, but it also, that's what you build bases from. But then the news just kind of worked itself out that it broke down instead of breaking to the upside. But that day kind of was your warning flag that, okay, it's going to be difficult for a while. And it was the same thing with the October 10th. But when we went into new high grounds prematurely, I think that really kind of screwed up everything. Hey, it is what it is. You just have to take the market that is given to you. So
Mhm.
what is all this is telling me is we need time. and we need to get back above the 21 day. And how far are we from the 21 day right now?
Right now, we've got about 2.7% to go.
Okay. So our first thing that we want is to get a close above the 21 day. Then the next thing, that's just your, your starting thing. And then you want to get your low, you want to get above it. And we were above it yesterday. And so you had to start doing some action yesterday, as you're going above it, because what else are you waiting for? Doesn't mean you go plunging, but you got to be buying some stuff there. Then it totally reverses and you got to be selling some stuff. That's just the reality. But now what we want to do is get back above the 21 day. Then the next thing is you want to get a close above the 21 day. Then you want to get the low above the 21 day and the close up on the day. Then the next thing that I like to look for is for your low to be above your 21 day for 3 consecutive days and closing up. And up in kind of a real way. Like if you see this last time, if you can point to that when we went above the 21 day for one day, like a week and a half ago.
And I can
Yeah, the
hear,
the
yeah,
gap
for
up. So
for
we
3 days.
gapped.
Yeah,
Yeah, so we gapped above it. That was your day one. Your low was above it for a couple days, but you didn't close up on the day. Now on the S&P you did, but it was really a stalling day in spirit. Let's go to the S&P on that same date. And so on this, you got above it. Your low was above it. You closed up. And then on your third day, you closed above it. But it was this tiny day and it doesn't look that bad on this chart. But when I was looking at it on my screen, it just didn't give you a sense of power. How much were we up that day?
the
That
gap
third
up.
day?
Oh, the
No, the
third
third
day.
day.
Yeah, just point zero
Yeah,
six
0.06,
percent.
with a 61% closing range. So it wasn't, yes, it was up, but 0.06 isn't really up. It's
That's just
it's
flat.
up on a spreadsheet, but not up in spirit. And that's how I like to look at things, you know, when that happens, whether that happens next week or 3 months from now or whenever, that's when I'll start getting more constructive. Is again getting above the final thing is you're low above the 21 day for 3 consecutive days and closing up in a real way that kind of tells you, okay, the trend, this is the potential beginning. It's not foolproof, but you could wait for 5 days, you could wait for 8 days, you could wait for 20 days. You got to pick something and study it. In 3 days I think is kind of the sweet spot. And the more days you have, the more conviction you get.
Yeah. Let's go ahead and go through sectors.
Sure. I'll let
We'll
you do
breeze
that
through
quickly
these.
because I know
Yeah.
we're over time and I got to hit the
um,
gym, man.
yeah, I bet, as you mentioned, this has just been kind of destroyed here lately. NLR, which was our nuclear, that's come off quite a bit. Even though there was a lot of energy discussion, and again, some of these were starting to look good at the beginning of yesterday with the Nvidia news. This just rolled over and really didn't come back at all today. I mean, it was off its lows, but still down 1.3%. Aerospace defense, another area that really didn't get much lift today. It finished down, getting lower. Gold, which again was, it's holding up, right there at the 21-day moving average line. Gapped up above it here, and it really hasn't broken down, but it just didn't really participate that
It looks
much in
like
the
it
rebound today.
wants to shake out below the lows of this week
Hmm.
and test the 50-day. And if it did that and had an upside reversal, I'd be all over that.
Yeah. IGV, which is our software. Again, there's a lot of big players in here, and Oracle, I believe, is certainly affecting this IGV, and bringing that one down. XLU, the utilities, a mixed bag here because there's a lot of the AI adjacent plays in here, but there's also the defensive. So you're getting a little bit of a mixed message there, but this is below its 50-day moving average line. SMH, that did close with a 0.3% gain, but still well on the up, the bottom part of this, upper part of today, but lower part of this whole range, and where it's been lately. So still has a lot of work to do. Same with XLK, the technology sector, Spider Fund looking very similar to that, and again, Nvidia being big components of both of those. So definitely, having its effect there. FNGS are mega caps, kind of looking similar to those as well. You do have Google, or Alphabet, I should say, the parent, that is just looking very different. Apple holding up well, but then you also have things like Meta, and yeah, that's just been looking pretty bad. Amazon has fallen below its 200, its 50-day, and is getting supported its 200-day. So it's really a mixed bag there. Energy, that has been coming up on our radar. It was a little surprising how ugly it got yesterday, but it was rebounding a little bit and up 0.6% today. The
I will
Qs,
say that some of the energy stocks, pull up the XOP, which
mhm,
is something we traded this week that looked really good. And there were some in there that were actually leading it, but we decided to go with it, that one. But it just didn't work out because nothing was working out. But I would keep an eye on this space because I think, as well as the medical, that things are clearly rotating into, that this might have a shot.
yeah, and I mean XLE, that's been just kind of trading right around its 50-day moving average line, but you do have some members in there like FTI. This is Technip FMC and the machinery and equipment. That's been trending here for the last few weeks above its 21-day moving average line, looking very different. And then you had some like in the transport pipeline that look like a solid breakout. So there's definitely XLE, there's some even stronger names within these groups. And I should also mention that this was one of the areas that our podcast guest John Kosar from Asbury Research was talking about XLE and the energy as being a place where money was flowing towards. um, Qs, we talked about that at length, and GDX is the next, because again, we're going from lowest to best for the day. GDX, just below its 50-day moving average line. Um, would like to see a little bit more oomph there for the recovery. SPY. This is, again, we've talked about this already, just to show you where it is with its 1% gain in the list of sectors. XLP, the fact that staples are a little bit stronger and getting up to their 50-day moving average line. Again, this is where people tend to hide, not really when they're too excited about the risk on play.
Take a look at
XLF,
Coke, for example.
yeah, Coke,
The Coke had a big day.
yeah, that was
That's
up
not what
to.
you want to see.
Mhm.
Yeah.
Walmart is actually another big component in the staples. You also have things like Colgate, Palmolive, and yeah, they had big days, but some of these are just in very poor positions. So XLF, you had some kind of gains there, possible support of the 200-day moving average line, but certainly some of these areas like Goldman Sachs and J.P. Morgan and the big banks, um, fell below their 50-day moving average lines after looking pretty good just a couple weeks ago. Industrials were up considerably, but again, this is kind of halfway in the halfway range of yesterday's action. So still has work to do, and I think that's kind
Can
of
I
the
say,
theme, right? A lot of these
yeah,
have
can I
work to
say,
do. Yeah,
yeah, something on yesterday's action on any index that you're looking at, or anything you're looking at, I would look at yesterday's high, yesterday's low, and not take anything serious until it's trading and staying in the upper half of that. And this
yeah,
one being in the lower half, I don't care that it was up 1.22. At least visually, it looks like it's in the lower half. It means nothing to me,
yeah.
through my lens.
No, I agree. It just feels like it has more work to do to
Hmm.
kind of shake off that day. And really, at the end of the day, yesterday was so negative, you really have to stack some things up on the positive side. And while this was a good start, it's got more work to do. XLRE, as you mentioned, the real estate sector was getting a little bit of a boost today. This was up 1.3, but again, the position is a little rough here, below its 21-day, 200-day, 50-day. But this did get above yesterday's action. It's just that it was. Um, yeah, not as rough of a day for it, and it was in a just very different position from the leadership. QQEW, we talked about that already. We've got XLC, the communications. This is still below its 21-day moving average line and 50-day moving average line really being dragged down by Meta. So even though Alphabet is doing well, those two are the biggest components. Meta really dragging it down along with a lot of other areas. XLY, this was up considerably, almost 2%. Amazon and Tesla are the two big components here, but this is still below its 50-day moving average line. And as we've been noting, if you look at RSPD, the discretionary equal weighted, this has been in a downtrend for a while. So a big day today, up 3.3%, but this does have some work to do because it's just been in this
I think
downtrend and needs
that
to
the
break
home
that.
builders are in that group, and I think that's probably what did it. Like pull up like a Lennar or an NVR,
Hmm.
and that's probably what was helping out the equal weight. Up almost 6%, but
Oh, I
they're
would have
just not
thought
in
that would have been
position.
like in the real estate. Those aren't in
No,
the
I'm
real
pretty
estate.
sure.
Oh, okay.
Yeah, I'm pretty
Um,
sure. I could be wrong.
okay. No, no, no. That I believe you. But um, yeah, so that's where XLY is. RSP, we talked about that. Certainly the all eyes have been on XLV lately, the healthcare sector. This just looks so different from everything we just looked at. Now, look, a lot of these, and this is what I wrote about in my column today. I used Amgen as an example. A lot of these had very poor relative strength just a few weeks ago when it was time to start buying them. So, yeah, sometimes you have to kind of recognize that sector rotation when that happens and something hasn't participated in the rally, especially a strong rally like we've seen this year. When the sector rotation happens, you're going to have some very depressed relative strength ratings. And, you and I have been mentioning that was the case with Apple back in 2004 from a perfect cup with handle. The really start of its move, between you know, the iMusic, the iPod, the iMac, all of those things that really just kind of this was even before the iPhone and
Hmm.
iPad. These things that really started to move in Apple, the Renaissance, if you will. Um, what was Apple's relative
55,
strength? 55.
55. Yeah.
Yeah, 55. When it was setting up in that cup with handle. So,
I'll say
yeah,
the XLV was the one thing that was on the bubble for us adding to
yeah.
potentially adding to swing trader today. They were adding it back because we had reduced it or removed it because of market conditions. But this is, I think, the only thing actionable right
Hmm.
here. But we already had everything we had
Yeah,
on swing trader
right.
was in medical, so we just didn't. Because what
Yeah,
what you risk
we
is,
had the exposure, right?
yeah,
Uh-huh.
if you get a real move back into, like, let's say chips in the AI space, the the medical will probably pause or pull back a bit, and then so we didn't want to get over our skis there. But I think XLV is the only
Yeah.
actionable thing right now.
Hmm. Arc K, that was coming back a little bit strongly, but again, up 2.25, but still, right around the halfway point from yesterday. So still has work to do. XLB, the materials, that was above the highs of yesterday intraday, closed in the upper part of the range, but still below the 200 and the 50-day moving average line. XBI, another area I do have a position in XBI,
As do I. Yeah.
as does Swing Trader. This one just looks, again, very different from everything else. The biotechs really having a strong move lately. KRE somehow snuck in there.
Let's go
Uh,
back to the XBI just for a second.
sure.
I know we're over an hour, but it is what it is. The Yesterday's action, the downside reversal there yesterday, it looked really bad in isolation, but on a relative basis, it was
Yes.
really good. But even given that, I my expectation was it to come in and test the 21 day, because that would have been normal and natural. So when something is more powerful than normal and natural, you want to pay attention to it, and it doesn't want to go down. Doesn't mean it won't go down, but again, I think that's the space to be in.
Hmm. The regional banks, those were doing fairly well, but again, this was getting support around the 200-day moving average line, but still below the 50-day, but very strong relatively. And then ITB, which we already talked about, having a strong day. Let's go ahead and take a look at some stocks, and Yeah, no big surprise. You chose all medical. So here's AbbVie, a nice looking cup with handle. Really came up strongly here above its 50-day moving average line. Again, yesterday just didn't stick out in terms of an ugly day, and today you were above the high of yesterday, and you look like you're on the verge of a breakout.
Can you hear me?
Yes,
Okay, can you see me? Because my video is frozen on my end.
yeah, it looks like you are frozen, but I can hear
Okay,
you.
okay, that's all that matters.
So, so,
People don't
so
want to see me anyways.
well,
What
I can see you're frozen, and it just looks like
I was
you're
pouring some water from one glass to another, and all of a sudden my thing froze. So I don't know what's
okay.
going on. So
Okay.
hey, look, let's go to a weekly on this one.
Hmm.
This isn't a leader in this space based on the way it's acting because it's kind of been uh, pulled. I don't know, something funky is happening with my.
Oh, and he dropped off. So hopefully he'll come back and he can finish his thoughts there. Um, but yeah, I'm not sure exactly what he was trying to get to in terms of that thought. But I'll also take a look at BrightSpring. BrightSpring. This is one we've been talking about on IBD Live for a
Are
little
you
bit.
there? Can you hear
I
me at
do.
all?
Oh, yep, I can hear
Okay,
you.
I don't know. All of a sudden,
Yeah.
everything froze and I came back.
Okay, let's go
So
back to AbbVie with the weekly.
okay,
You
what I
were
was trying to say there was this isn't the leader in the space, but what we were doing was looking for things that were in position to be bought. So go down to the quarterly numbers on this one. Um, so you're not looking at anything that it's to write home about. You got negative numbers there, mediocre sales growth, but it just tells you that this one is in position. I would do a little bit of research if you have the time. It's is a B or a C quality thing, but let's go to the daily. At least it's in position. So more so from a
mhm,
swing trading standpoint is, if it can take out really today's high or the high from 2 days ago, then you could have an entry using today's low as your stop. But I would say a lower quality,
mhm. BTSG, Bright Spring Health Services. I do have a position in
as
this.
do I.
I've actually, held through this little choppiness here because I had enough cushion for it. But I don't know. Would you consider this almost like a little mini double bottom here?
Absolutely. Yeah.
So,
So Bill O'Neill would want 6 or 7 weeks of to be an official double bottom, but that's in the spirit of a double bottom in my view, and kind of like a shellfish, a shelf but double bottom where you undercut the first one. And even though it was buyable a couple days ago, I think it's still buyable right here. And you do want to pay attention to the ones that had decent days yesterday or that were kind of disconnected from the overall market of what that did. And like pull up AVGO, Broadcom,
mhm,
which is kind of the poster child for what happened yesterday. In the morning, it looks great and is way up there, and then it comes and goes down. Or let's pull Nvidia back up, which was kind of directing the traffic yesterday. Breaking out and going above that downtrend looked great, looked like it was going to go through 200 in a blink of an eye, and then crashes back through its 21-day and its 50-day. Now let's go back to the stock we were just looking at, and it looks like it wasn't even in the same environment. It was
mhm,
up, yes, it was off the highs, but it stayed above the 21 day. So that's what I'm looking for right now, is things that are uncorrelated in the very short term. And that's very easy to do right now. Just look at the last couple days, search for stocks that didn't have moves like that yesterday. Anything that had a tiny spread yesterday, that's going to go to the top of my watch list, assuming other things look good on it, not just something down and out. But look at yesterday's spread. Tight spreads yesterday means it's disconnected from what's going on with all the gyrations. And that's where I'm going to spend most of my time. And this looks good. And I think it's still buyable here, even though the original buy point out of the cup was your classic place to buy it, or off the 50-day earlier this week, or through the 21-day earlier this week. But now it's right at a double bottom, so I think it could be added to. I
mhm.
just wish I had a bigger position. It's a tiny baby
Yeah,
position,
right.
man.
Yeah, I hear you. And let's go ahead and wrap it up with Alphatec.
So this was the poster child for what I was talking about being disconnected. I don't really know this company, but I was looking through and going, okay, what is something that I would like to leave people with to study stocks like this weekend? So what do you have? A classic, breaks out of a cup without handle, goes up more than 20% within 3 weeks. That's that little flag there, the 27, telling you that it's doing something, that there's something special there potentially, then holds above its 21-day this week. But really, it's all about, for me, it's all about yesterday. It is very small, close, almost unchanged. And although I don't use volume because I think volume is dirty, in this case, I would look for stocks that had low volume yesterday because as a sign that it was disconnected and not just part of a bunch of baskets that are being traded, you know, because if you buy the Qs or you buy SPY or SQQQ or what have you, you're buying a bunch of stocks and they're just going up and down with those money flows. This one looks disconnected. Let's go to the weekly just for a second to see the overall position. And of course, it's in the medical space. The bad part about it is that bad week in 2024. I wouldn't trade this stock without going and researching and understanding what happened that week. I didn't have the time to do that, but you have a couple other bad weeks in there after that, but it's been able to power higher. But when you've got a bad break like that, I like to wait until it can prove itself that it can hold above that for a material amount of time and price, and it's been able to do that. So that's forgiven, but I would just pay attention. I would go and research that so you know what the story is there.
Mhm. Final question, Nasdaq. Okay, it's too early to call this a bear market. This is
Oh
just,
yeah.
right now it's a correction. Do we need a follow through day in your mind?
If Bill were here, he would be looking for a follow through day, without a doubt in my mind. But my thoughts on Bill's original work that he did on the follow through day before both of us were born, and I'm older than you, so that means I'm really old because you're old. You're ancient, you're a grandpa and all, but
True.
he was doing it to get into the bottom of bear markets. So April, that was a bear market. I don't care what people say. That was a bear market. That's where you would originally want a follow through day. Then he kind of boxed himself in a corner because he started saying, okay, once you get max distribution, and originally that was 4 days, and it was 5 days, and it was 6 days, and then, you know, it kept on changing. Then he said, when you get all those days of distribution, you need a follow through day, which is problematic. And that's why one of the reasons why we came up with the market school rules to kind of fix that problem. He would be looking for one there. But I know we both knew him inside and out. And he would change and be like, if things started acting right
Right.
and there wasn't a follow through date, he would be like, oh well, blah blah blah. And
Here's
like,
why you didn't need it and why you should have been
yes,
buying anyway. Yeah.
yeah. So the way we look at it with our rules, we don't need one right now with the
Right.
market school rules because we still have a buy switch on and a +1. Which, what does that mean to people? Nothing unless you've taken the course. So don't worry about it. It just means you can still act on buy signals using that philosophy.
We
The
just
buy
haven't
signal,
gotten any in a while. So just to
yeah.
be clear.
So what I'm going to be looking for is moving back above that 21 day, which is also in line with the 50-day, and that is going to that's what I'm going to act on, or like a real upside reversal. Like today wasn't, it was just technically in a spreadsheet, it'd probably be an upside reversal, but it didn't have enough of an oomph down or a move back up. It's just a day that took out the low from the prior day and closed up, as far as I'm concerned. So to answer the person's question, no, I don't. I'm not looking for a follow through day. I'm really wanting the volatility to subside. We're also in this position that we could get there's a lot of news, both negative and positive, but I think a lot more on the positive side that could come about. One thing that we didn't talk about was the Fed funds futures. That's been all over the
Yeah.
place recently. If you haven't looked at it, I mean, that's kind of moving the market around. I think there's this obsession with the Fed funds futures for the December, I think, a December 10th meeting. Dude, it's not a big deal in my opinion. It's like, okay, a quarter rate cut then, or are they going to wait to the next meeting? That's what everyone is getting worked up about. I I think it's a non-event. Powell did a really good job at the last meeting setting it up to put bullets back into his gun that he could shoot, and that means with another rate cut. So they won't use it if they don't need it. Yeah, thanks. So here's why don't you walk through what that is for folks?
So
Because it
it's
would
just
take me a
basically,
half an hour.
yeah, it's just basically saying that there's a 30% chance right now. Our target rate is between 3.25 and 4. There's a 30.6% chance it's stays pat. 70% chance, 69.4% for a cut. And again, to your point, you could see how different that is. That 69 just yesterday was 39. A week ago it was 44. A month ago it was 98. So it's all over the place. And look, this is just what the Fed futures, this is what people are kind of betting right now. It changes a lot, and as we saw over the last couple of years, it was horribly wrong. The guesses that they had were just horribly wrong, especially the further you went out. So just keep that in
Yeah.
mind.
But Powell pays, my opinion is Powell pays a lot more attention to this than he lets on. He does not want to surprise the market unless he wants to surprise the market. And right now, as he's getting ready to retire, he doesn't want to have any egg on his face. And so I think that's why he was tempering, because he doesn't have everyone on his team thinking the same thing. You can look at that at the minutes or just as people are talking. And so some people want to pause a bit, some people want to cut now. The good thing is no one's saying let's raise it. So we're going in
Mhm.
the right direction. It's just what speed are we going there? Are we in the fast lane or are we in the slow lane? And I think the market's obsessed about something that's not that big of a deal. Um, if some of them were saying let's raise it or pause forever, then that would be a big deal. But it's just the pace at which it's
Yeah.
going, and I think that's the market always has to worry about something. I would say there bigger issues out there than that.
Mhm. Well, hey, Mike, it's time for you to get to the gym, and it's time for me to start working on charts. Rachel, our producer, also has to join me in putting all those little analyses on the IBD 50 and Big Cap 20 charts. So
Can I say
we're going to
one
go.
thing,
Sure.
Justin? I just want to say I hope you and your family have a great time in Hawaii next week. You will be
Yes.
missed,
Okay.
and have a lot of fun. And we'll be counting the days till you get back.
Okay. Yes. And I hope everyone has a very happy Thanksgiving. We'll see you all on Monday, IBD Live. We'll start up 6:20 Pacific time and 9:20 Eastern time. So join us for that if you haven't already at investors.com/IBD Live. Or you can come right back here tomorrow. We'll be live after the close Monday for the Stock Market Today video. Have a great weekend, everybody. Take care.